Hi everyone and welcome to another episode of Monday Market Outlook. There's nothing much that happened last week. We only had 3 trading days and 4 trading days for the US. So we're going to open up this week with a full trading day for the US and again a shortened trading week for the PSEI. Now, the biggest headline from last week was the announcement of oil output cuts by OPEC countries. No? So Saudi and other OPEC oil producers announced early last week that they will cut oil output by 1.16 million barrels per day. So because of this, if we look at the US oil chart, the US oil prices came back up at around the 81 level. It was down to around 65, 66 per barrel already. So now it came back up and it will probably stabilize at this level for a period of time. Now what is happening here is that there are a lot of market speculators already starting to short US oil, right? And what OPEC is basically doing is trying to punish those people who are trying to short oil prices, because as people continue to short it, prices of oil will continue to go down, and it's really not something that the oil producing countries would like to see. This resulted into the market being a bit bearish. So if we look at the PSEI, it came significantly down in the last 3 trading days. It hit resistance here, and we're trying to work around this resistance level. So this week we might see the PSEI just moving along 0.38 and 0.5 fib. Now the US markets also became bearish until it recovered by the end of the week. As predicted, we were already seeing a trend line going down before trying to bounce up. The main concern for the US really is that inflation is already going down for the past few months, and a significant jump in crude oil prices may cause inflation to spike again in the next few months before resuming its downward movement. A spike in inflation may force the Fed to hike rates for another 25 basis points this May. Again, the Fed has already communicated that they will look at all available data and make a decision by May 3. That is something that we have to look out for, and it is causing some fear into the markets, because as rates go up, markets will react negatively to it. Looking at the PSEI, here were some notable movements on the PSEI as expected, right? So SCC, after its X date, went down dramatically, almost 10% to its support level at 29.30. Right now, as long as SCC is able to hold this support zone, we might see price movement trying to fill this gap. So remember, this is a gap, and we've always said that most gaps will eventually be filled, right? So we might see SCC trying to fill this gap in the next few weeks, right? Traditionally, SCC gives out dividends every April and October. So the next dividend would be in October. So you have like 6 months to monitor this stock before going in. Now, don't go in when it's near October, right? So maybe 3 months before that. Look at the price movement, and if SCC is a stock that you want to consider for a dividend play, you may want to monitor SCC price action in the next 3 months and look for opportunities to buy in. And of course, SCC's business outlook for this year is not as good as it was the past years, right? So really, you're just holding on to SCC because it's undervalued, and also it's a great dividend play. So let's look at some price movement in the first quarter of the year. Of course, SCC here down 20%, but we have CREIT, BPI, the banks, and Bloomberry and Apex, most of our picks up, right? So that's why you need to have, aside from your dividend plays, AREIT, right? AREIT, SCC, DMC, which are all in the negative, you need to have growth stocks in your portfolio also to offset those drawdowns. And then going to the SPX also in the US, if we look at the last 3 months, for the past quarter, the winners are semiconductors and tech, right? But if you look at the last 5 days, there's already clearly rotation happening towards the defensives. Look, here we have healthcare, utilities, XLC, communication, energy, biotech, gold, XLP, which is consumer staples. You have here the defensives outperforming the SPX. The market is slowly shifting towards a defensive play, probably anticipating a hard landing for the US economy. Now let's look at some charts here that I usually monitor and try to give everyone a sense of what they are, right? So this particular chart here is the federal funds futures rate. The federal funds futures rate is basically the market's interpretation of where the federal funds rate will be in the future. What the market was saying before is that, so here's the federal funds rate right now. It's at 5%. So the market was saying earlier this year that no, you're going to pivot, right? It's going to be at 4.2. It's not going to be at 5. So that's what the market was saying. So if you hear headlines about, the market is disagreeing with the Fed, this is what it looks like in a chart, right? So the market is disagreeing with the Fed because the Fed is saying we're going to be at 5% this year, and the market is saying no, you're going to be at 4.2. You're going to pivot soon. But the market is slowly starting to realize that, okay, wait, maybe the Fed is right. Maybe we are really going to stay at 5% for the rest of the year, because look, the market is now slowly going up and slowly agreeing with the Fed, especially during the last few days when OPEC already announced oil production cuts, because this might reintroduce inflation. And okay, the market is starting to slowly agree with the Fed that we really need to keep interest rates high because things like these oil production cuts might happen. Okay, we now get it, right? Another chart I look at is the 2-year yield and the 10-year treasury yields. Now, the 2-year treasury yields are basically, treasury bonds and the yields that they give out. It's 3.9%, right? The 10-year US treasury yields is at 3.3. You might be wondering, why is a 2-year yield at 3.9%? So imagine the 2-year interest rate is 3.9%. And if you invest for 10 years, they're giving you 3.3%, which is lower. Why is a 10-year treasury bond giving you a lower yield than a 2-year treasury bond, right? So this is basically the definition of an inverted yield curve. So if you're hearing that term inverted yield curve, that's what it is. The 2-year treasury, the short-term treasury rates are higher than the longer-term treasury rates, right? So because the market is predicting that farther into the future there's going to be a recession. So that's what this means, right? So we also monitor the 2-year versus the 10-year treasury yields, right? So this means that this chart basically means that the spread between the 2-year and the 10-year has peaked at a 1.2%. Right now, the difference is currently at a 1.173%. When interest rates in the US goes up, right, the dollar also becomes stronger. Now, this is the reason why the dollar became very strong last year, right? So every time rates go up, the US dollar also goes up, and when it goes down, right, the US dollar rate also goes down, which also explains why the peso dollar exchange rate has improved significantly from 59 to 54. When threats of an inflation happen, what usually investors do is find what we call safe havens, and gold is a safe haven, right? So when the market is starting to panic and they're looking at a recession, investors tend to go to safe haven assets like gold, which is why a lot of people are bullish with gold, especially in the coming years, because as the threat of a recession looms ahead, right, gold is a safe asset. Of course, as gold prices continue to go up, business prospects for one of our winning stocks, Apex, is also going up. Q2 earnings season is already going to start next week. All eyes would be on banks' earnings because of the recent SVB and Credit Suisse bank runs. BlackRock, Citibank, Wells Fargo, JP Morgan coming out with their earnings reports on Friday. Now, looking at the SPX chart, we are currently trading here. These are the options, right? So if we look at the options here, the market is still quite bearish. We have a put wall here at 405 and a call wall here at 4112. So this is 4112, this is 405. So the market may just trade along this range for the coming weeks, right? So that's it for this week. I hope you enjoyed our episode. Please like this video, subscribe to the channel, and good luck with your trades. Manage your risk accordingly. And that's all for this week. Bye-bye.